Hedge, a tackle trading glossary video. What is a hedge? Well, by definition, a hedge is a strategy to reduce the risk of adverse price movements in an asset. It can be used to minimize or offset the chance that your assets will lose value. It also limits your loss to a known or a predetermined amount if the asset indeed does lose value. The three most common uses of a hedge are: one, to protect existing profits. Once you have a position that's in profit, one can add a hedge to a position in order to protect those profits. Two, we can use a hedge to mitigate losses. One can add a hedge to a position to mitigate or even potentially reverse a loss. And three, savvy traders and investors know how to do portfolio protection using a hedge. You can add a beta-weighted hedge for your entire portfolio. And beta weighting is just a fancy word for knowing how much of a hedge you need to put into the portfolio by comparing how volatile each individual stock is compared to the whole market. Now, let's look at some examples of how one might use a hedge. We could hedge an individual position, like a single stock. Say you own shares of Apple or Microsoft or Google or whatever. You can develop rules on when and how to hedge each position. You can buy protective puts, for example, and you can hold those inside of your trading system. You can use different option strategies to create hedges, but the most common hedge in the world is known as the protective put option, which simply gives you the right to sell the asset at a higher price when you purchase that option. You can also hedge a group of positions. So if a group of positions was at risk, for example, if you had a handful of stocks in the energy sector and you wanted to hedge those stocks, you could use a beta-weighted hedge. You could measure the beta or the volatility of the stocks compared to the market, and a hedge could be added to protect against adverse price movements in the group of assets prices. And then, again, you can hedge an entire portfolio. A beta-weighted portfolio hedge can be added to a portfolio as protection, and traders will use options, put options, or futures contracts or some other instrument to offset downside market risk for an entire portfolio. The key to knowing how much of a hedge, how much insurance, how much leverage you need to use on that hedge is the magical world of beta weighting. And you might want to look up our beta weighting definition here in the glossary. So you can get a better idea of what a beta-weighted hedge is. But that, ladies and gentlemen, is some really good preliminary information for you on what a hedge is. In essence, it's an opposing position. You can buy or sell options or futures or some other instrument in order to offset your risk on existing positions. If you enjoyed this video, come hang out with us more. Learn, trade, connect, succeed. Visit bit.ly/join tackle pro and take advantage of our 15-day free trial on our pro membership.